afternoon or this evening. We've had another busy day in the markets. Let's start out by what we had today, which was a big trade on bonds. And obviously today was all about the CPI numbers. And again, this idea that knowing what's driving your market is very, very important. We all know that the CPI numbers that were going to come out of the States were going to be very, very important to us. And we try and make an assessment about what we should be doing. Now, there's two things that we make assessment on, what we call the five-year, which is inflation break-evens. So you might see it reported in the likes of Reuters or Bloomberg's as a 5-year inflation break-evens. So we obviously want to know what the 5-year inflation break-evens is doing. Why would we want to know that? Because the inflation break-evens is basically a direct link to the direct dealers. Now, if you don't know what the direct dealers are the main body of traders who trade with the Federal Reserve, New York desk, and deal directly with the Federal Reserve. There's a list of banks that are authorized as direct dealers. Our own bank is one of the direct dealers for the Federal Reserve as well, so we do have some insight into that, although I don't deal directly with New York. But our bank does, and there is obviously insight into the direct dealing network. And basically what we do is we come up with an assessment. Now, it's obviously got to be an assessment that's replicable on the screens. So there's no point in me providing insight into conversations that perhaps take or perhaps don't take place. So what you've got to be able to do is see what the conversation is by way of trade narratives. Now, obviously, what that means is we know what the direct dealers should be and are doing. Take a look at what happened 20 hours ago. This was obviously at 11 o'clock last night, so obviously it's a good 14 hours before today's US CPI numbers. Happy with the dates? They're all time-stamped, so there's no fooling around with Photoshops or anything like that. The guys will tell you this is the timestamps. And the first thing that I sent out as the first thing I sent out as a tweet was the bonds, direct dealers. So here we go. This is us now talking about the direct dealers storyline on treasuries. Direct dealers on the inflation desks are definitely bidding up bonds this afternoon. They're bidding up bonds. Why would they bid up bonds? What does that do to yields? That drives yields down. Why would you drive yields down? Because you're expecting a bad CPI print. That one single piece of information, is telling us that the buying does suggest a lower CPI print. We're telling you this 14 hours before the CPI print comes out. Now that's pretty impressive, isn't it? It doesn't have to be right, but it's pretty impressive. So what happened on the CPI print at 1:30 today? The forecast was for 0.2 headline. The prior was 1.3%, and it came in at 0%. Zero. Not even 0.2. Came in at 0. The core number was prior of 0.7. The forecast was 0.5, and that came in at 0.3. In other words, the two CPI prints missed. They both missed. Guess what? 20 hours ago, we told you that the direct dealers were buying bonds, suggesting a lower CPI print. We told you they were going to miss. But we never told you. The markets told you. The markets were able to advise you that this was going to be a missed print. Now, we know that that's possibly a good news story for equities. Agreed? Does everybody agree that the reason why equities have been selling off recently is because of higher inflation? Well, it's not necessarily because of higher inflation. It's because of what higher inflation is doing to interest rates and Fed policy. Ramping up interest rates by 75 basis points, 100 basis points, simply to try and get control of a rampant inflation environment. That's what's causing equities to sell off. Well, take a natural, logical conclusion from a miss on the CPI print, and all of a sudden you're starting to think to yourself, I should be buying equities ahead of the CPI numbers. Is that a reasonable conclusion to reach from this direct dealer buying? Is that a reasonable conclusion that you could reach? Well, we all reached that conclusion in the room. Well, some of us did. I can't speak for people who hadn't typed in the box, but we'd reached that conclusion that if this is the case, we should see bonds going higher on the release and equities going higher on the release. And we're telling you at 20 hours, well, 20 hours ahead of when I took this screenshot, but we're telling you this at 11 o'clock last night London time, which is obviously 14 hours before the CPI number comes out. The reason why I've posted the second one at the top edge is because it would be unfair for me to leave it as just simply, look at us, look at how good we are, because we did put a caveat on this trade. The caveat was, once the CPI number comes out, I really actually want to be selling bonds. I actually really want to be selling bonds because I have a very strong idea that the bond is actually a sell trade. So obviously if we do get a very soft CPI number, I'm expecting the price to go up and then sell off. That would be an expectation, and we can see that from my second tweet. The biggest issue at the moment, bearing in mind these tweets are both coming out literally one after the other, the biggest issue at the moment is the net curve is very flat. Very flat at the back end. Now, if you don't understand bonds, you might be losing a little bit in the translation or a little bit in the terminology. The back end talks about the longer duration bonds like the 10s, the 30s, and the ultra bonds, suggesting some strong upside yield movement. So the curve is telling me that there's a lot of a higher probability that we're going to get some strong upside yield movement, keeping me bearish at top edges. There's the important part, right? Keeping me bearish at top edges. Now, if the direct dealers last night had agreed with this bearish top edge strategy, there would have been no choice for me. I would have sold everywhere and everything. You see what we're trying to say? So the key takeaways from this is very, very simply. The key takeaways from this is very, very simple. Bearish top edges. Now that's the macro read on this. This isn't the CPI read. This is the macro read. And then the direct dealers on the inflation desks are definitely bidding up bonds this afternoon for the CPI numbers, suggesting a lower CPI print. So therefore, we're buying the CPI print and we're selling the response if we get the top edge that we expect to get. Now, you might say, well, I don't really get that from those couple of tweets, but that means that you simply don't understand what we're saying here, and that's okay. That's something to learn, isn't it? Something to understand going forward. So what actually happened here? Well, let's take a look at what actually happened to bonds. So this tweet comes out. The direct dealers had bought bonds here. We draw a line across our charts, and you can see that we're seeing another buy opportunity here at the London Open. We draw another line across our charts. We see another buy opportunity on bonds here. And then we see, obviously, that they decide to try and basically smash everybody's buy positions. Everybody knows that this is what happens. They sweep the price lower to get rid of the buyers, to get the buyers to puke their positions at lower prices. Good, as far as I'm concerned, because it means I can buy even more treasuries at a discount. So obviously they swept the price down. In fact, we did have a little sell signal just in here off the 24s, but that's not relevant. And you can see we swept the price down into this area here just before the CPI numbers. Now, bearing in mind the CPI numbers are particularly linked to this storyline here. They're bidding up bonds. The direct dealers who have a hotline to the Federal Reserve trading desk in New York are buying treasuries, allowing me to understand that, very simply, we should be buying ahead of the CPI numbers. We should be buying equities ahead of the CPI numbers. We should be buying bonds ahead of the CPI numbers. So the buy comes in, and as you can see, the CPI number comes out. We get this massive miss on the CPI numbers. They did a cheeky little sweep on a short-term chart. They swept any stops. The last of the dregs of humanity got swept out, and we just simply stepped right in and bought as many bonds as you could afford. But it's a gamble. Well, I'm not saying for 1 second that it's not a gamble, guys. You've got to know exactly what you're doing here. You've got to know what kind of risk tolerances you've got. But we've got an incredibly strong storyline for this buy trade. And what happened? The initial knee-jerk spike happened. That's what happened. And obviously we got what we call aggregation into that candle phase here. We took out the wholesale price of 159s. And now what am I now focused on? Now I'm focused on the second tweet. Bearish top edges. Well, this is a top edge, but obviously in the background to this chart, there is another top edge that's rested some time ago. There was a big reversal candle coming off the 159s. So we already knew that there was a top edge up here. So now what we're doing is we're waiting to see if the price does now stall. I'm not saying we sold 16s, but what we started to do was we started to work some sell orders in this area between 159 evens and 159.08s. We started to work into that as a short position just there to take advantage of this back end strong upside yield movement. Now we lost some of the value on the data release, of course, with a very poor CPI number that we saw. You're going to lose some of the value in that, so we had to reassess how much value we did have, and on a macro scale, well, we still had value. Make no mistake about it, we still had value. Not a lot of value, but we still had value. And obviously, based on that value narrative, we were able to then work into some sell orders and take the market south. Now, this is all tweeted in advance, and the reason why we show you these each day is because we want to try and give you guys an understanding that this isn't a retail trade room. This is putting you on the institutional desk. It's not like talking about Fibonacci extensions and moving averages as we've talked about before. It's not like you look at what's happened. We've came back to an order block and therefore we're selling and all that kind of stuff. That's not what we're doing in this room. We're placing you onto an institutional desk and we're asking you to step up. We're asking you to start understanding what's going on in the markets. You're talking the same talk as Barclays, as the Federal Reserve. You're talking about steepeners and flatteners in the interest rate curve. You're understanding the relationship of the STRS market to the longer duration markets. You're understanding the concept of duration, in fact. You're starting to recognize the concept of sentiment, the concept of duration in the equity markets. You're starting to understand those elements. You're starting to see these. Now, it's not hindsight. That's why we post these, because a lot of people will say, yeah, but how much of this is all hindsight information? 20 hours before it happened. How many stochastics can find a trade 20 hours before they happen? None of them, right? None of them. How many moving averages can come up with a trade 20 hours before it happens? None of them. So you can see that Fibonacci can't do it. Gann can't do it. Elliott Wave can't do it. The only thing that can do it is proper institutional trading, proper institutional knowledge. And we've shown you many of these tweets in the past. We've shown you many of these ideas. And obviously, we're focused today on the CPI numbers. That was their big play. Now, obviously, if you decided to trade CPI numbers today on equities, my goodness, knowing that same event on equities was brutal, wasn't it? It was absolutely brutal. So we can obviously understand a little bit about the buy trade off of 41.36, right? We'll come to that in the classroom session. But it went 41.36 to 42 evens. Oh, yes. 60 points, $3,000 profit per contract in 5 minutes. $3,000 profit per contract in 5 minutes. Now, again, do I recommend for newbies coming into the markets to start buying equities 1 minute before a CPI number comes out? No! But if you know your risks, if you know how to manage your risks, and you like a little bit of a flutter on the markets every now and then, because it's still a gamble. The direct dealers may have got this call wrong. I don't think so, but they may have got the call wrong. Then, of course, that's up to you to make that decision as to whether you're happy with the risks, you're happy with the way it's setting up, and you're ready to rock and roll. Now, one of the things that did set up was what we call equity duration. And obviously, when we obviously understand the concept of equity duration, the idea of equity duration is visible on this little chart here just before the CPI number comes out. So you can see just before the CPI number comes out, do you see the blue lines actually starting to curl up the way? This is a positive correlation on duration, guys. So what we are seeing is equity duration is rising. If equity duration is rising, that's because equity duration is similar to bond duration. And bond duration rising means long the back end of the curve, long bonds. So in other words, we're starting to see a long equity, long bond storyline coming into the CPI numbers before the CPI numbers comes out. That lines up perfectly with what we understand to be a bullish bond market from the CPI numbers, a disappointing CPI print. Well, that's what we'd already told you we were expecting from the direct dealers price action from the day before, 20 hours, 14 hours, 16 hours before it even came out. So now you're starting to see that the way to trade the markets is through knowledge. That's the way to trade markets. How you actually implement that knowledge is a huge different question. We've had many questions regarding the concept of implementation. Where do I take the bloody trade? Well, we've got to know that we want to take a trade first, right? Knowing where to take a trade and how to take a trade, it comes after we know that we want to be in the trade itself. We had a great question from Andy in the room earlier on today, and he was asking that very question. Yep, I see that I want to be in a trade, but where is my entry price? And the answer is it's personal to you because everybody's got a different tool set. Well, tomorrow you'll see some of the tools that the guys use in terms of order flow to try and get very close to the price action. We touched on that yesterday. So somewhere in this area here, there was an opportunity to buy equities. And depending upon what tool set you've got access to, depending upon what size of stop you've got access to, you were able to buy into this. The other part to that question was, how do I manage a break-even stop? And I suggested a solution to a break-even stop. Don't use one. You might be saying, what? Don't use a break-even? No, don't use a break-even. Take responsibility for your bloody trade. Passing your responsibility to the markets is just lazy trading. No professional that I know uses a break-even stop. They'll take out a trade at break-even, but they won't have a hard physical stop there because things change during the trade. The value might improve dramatically that I don't want to get stopped out at break-even just to buy straight back in again. So I've got to be able to be flexible with when I deal in and when I deal out. I want to have responsibility. I want to take responsibility. Does that mean not having any stop? No. But you have a defensive stop miles away. So when I'm buying into this S&P position here, if I just bought it, say for example, at 24 minutes past 1, 6 minutes before the CPI numbers, if I bought it off of the bottom edge, price went up and stopped me out. If I bought it again, the price went up and stopped me out. So potentially I wouldn't have been in a trade. However, if I have very simply a defensive stop, which is maybe resting away down here, for example, so that if I get stopped out, it's probably because I've screwed up somewhere and I've maybe died at the screens and the price has done whatever it's done, so be it. It's a defensive stop. It should never be traded, ever. And I was saying to the guys, I can't remember over the last 40 years that I've ever had a defensive stop traded. It doesn't mean that every trade's won. What it means is I've taken my decision about whether the trade is good or not. I've taken responsibility through knowledge. This trade is not getting any better. I'm going to close out my trade at break-evens. I decide to close out my trade at the break-evens, not because I've got a break-even stop, but because I've decided that that's it. The trade isn't going to go any further. It's a very, very important element to this, and that's why we get into trades, take some small profits and get out. Now, one of the suggestions I made was, especially on a buy trade like this, if I bought some 37s, I don't treat each contract as a trade. I treat the trade as an area. So in other words, this bottom edge here is one single buy trade. Inside that buy trade, there might be 3 or 4 entries, 3 or 4 contracts if you're a retail trader. So how would that work? Well, let's imagine you're a 2-lot trader and you're trying to buy this downtick here and you pay 37 for a long position. And you pay 37 for a long position and it trades 38s. Okay, good trade, 4 ticks. And you say, right, it's moving up, but I don't want to be in 2 contracts at this stage. Let's see if we can take that 4 ticks off, and you take 4 ticks on one of your contracts. Now you can run a 4-tick stop on that trade, and potentially you still have a break even, right? So there's your stop just now. And you come back in again, and you say, right, I'm buying it again. And this time the price goes all the way up to 40, right? Goes all the way up to 43 for argument's sake. Goes all the way up to 46. Goes all the way up to 47, and you say, wait a second, I've just made $500. I've made 10 points. So I take a second contract off. I'm still long 2 contracts. I take another contract off, and I make 10 points. Well, the whole trade is now a break-even away down 10 points lower, isn't it? So I could actually put my hard stop down here, and anywhere in this area, anywhere in this chart now, if I take a hard stop at that price, I'm still going to make money on the trade being the buy at the bottom edge. I'd still make money. I'd still make a net profit. Now it'd be a bad, I've given away an awful lot of my open profits to achieve this opportunity, but I've given myself room to watch what's happening in here. I'm starting to build up a very big cushion on this trade. Now, even the institutional trader sees trading as a trade. It involves 10 or 15 or 20 entries. It maybe involves 10 or 15 or 20 exits, but it's all one single trade. You're not taking individual contracts and figuring out whether that trade was a profit of 3 and then that trade was a profit of 5 and that trade was a loss of 8. It's a total trade. It's just a buy trade. So I'm trying to manage my buy trade so that I get a massive cushion so that I can simply sit in this trade whilst the trade develops. And obviously what happens on occasions is this is what happens on occasions, right? We get this enormous buy-side response to a very, very obvious buy trade opportunity that we already tweeted 20 hours prior, remember, based on 20 hours prior, based on the direct dealers. But did everybody know that if the inflation number came in poor, that the equities would go up? Is that something that everybody knew? Well, many people would, but some people probably wouldn't. So therefore, that's lacking in knowledge that you can implement when you know this stuff, right? We spend a lot of time making sure that people are learning the language of the marketplace, learning about inflation break-evens, learning about inflation rates, and learning about fundamentals and their relationship to the markets, because it's not always that simple. Sometimes inflation is positively correlated to equities, and sometimes it's negatively. What do you mean by that? Well, think about this for a very, very simple throwaway. In the early days of a recovery, the reason why inflation comes out is because of demand, the demand for products, the demand for supply, the demand coming in from buyers in the outside market, right? So that demand is driving inflation, but the inflation is miles below the Fed target range. So maybe the Fed has a target range of 3%. So obviously if we see inflation, that's going to be good for equities. There's no intention, of course, during that period that the central banks are going to start ramping up rates to 5 and 6 and 7 and 10%, right? So equities have a lovely upside because of growth in their markets. They're starting to see buyers coming in and buying stuff. Apple starting to sell some iPhones and the like. The markets are feeling good, sentiment's building. There's a lot of positivity because of inflation. But we get into the end of the cycle. And now that the Fed is starting to lose control of inflation, the interest rates are starting to ramp up higher. So therefore, the idea that inflation is always positively correlated to equities is simply not the case. At the moment, inflation is negatively correlated to equities because of the impact that the central banks may have to bring in to try and bring inflation under control. Now, this is all stuff you learn when you come into our classroom, because this is the stuff we talk about every day, because we're always talking about what the institutional trade desks are talking about. What's driving your market today? And it's not a CCI or an RSI or a stochastic. So great news. Okay, so now we've got rid of the initial introduction to stuff. It's time for the challenge, the market maker section. And I also want to touch on another thing that we want to show you guys as a little freebie from from today's classroom, and it's the concept of pump and dump and the concept of bear raids. But we want to touch on that as we come to the end of today's classroom, and you start seeing some incredible ideas coming from things like market delta to use on your charts tomorrow. Okay, so what we're going to be doing, guys, is very, very simple. Structure on the S&P prior to the CPI numbers. So in other words, what I want you to do is I want you to go back to the early stages of the equity markets and start finding the level 2s. Start recognizing the price action. So I want you to take to London 7 a.m. in the morning. And I want you to work your way towards 10 o'clock London time this morning on a 1-minute chart on the S&P, and I want you to narrate your charts. Now that's the challenge. I want you to narrate your charts properly. So what we're going to do is we're going to take a little 60 seconds break here to start letting you have a chance to look at it. Think about what your narration might be. Put some ideas on your charts perhaps, or simply know what your ideas are. Taking it from 7 o'clock London time this morning. Obviously, US have to make a 5-hour adjustment if you're in the East Coast, a 5-hour adjustment to find out what that trade time is on your own side. But get an idea of when you would have changed market structure, where you would have put in some level 2 buyers or sellers, where you would have started the automation process of the HFTs, where would they kick in terms of HFTs, and have a little look at what the London session would have given you. So take 60 seconds, guys. 60 seconds is now on the clock. And then we'll work from 8 o'clock through to maybe 10 o'clock this morning, and then we'll work our way forwards towards the CPI numbers. Okay, 60 seconds, guys, 60 seconds.
I feel like we need a little Jeopardy, the little doon doon doon, right? And if you're just joining us, get in and get on your charts. It's time to get to work. Welcome in day 3. Countdown is on.
Okay, so what did you have? What information did you have, guys? Well, obviously, if you're in the room, you had some information that you could already start filling in your charts with. Now, that's obviously something that's a little bit of a cheat because it's already done for you. And if you look at what we had in the room, we had some information for this morning. We had the key levels. And this is the key levels here. We had a price of 41.13s. We had a big price here of 41.31s, 41.32s for the floor level. We also had a price of 41.39, 41.40s, a 41.46 and a 41.50. So we already had a lot of key information here, to start working some key levels today. Key levels on the way up tomorrow if we catch a bid off that CPI number. Remember, I'm expecting a bid from the CPI number, so I'm more interested in the numbers going up than the numbers on the way down because of that reason. So the bottom line was 41.13, so we could obviously start out by drawing in 41.13s on our screens, right? So we could start out by drawing 41.13s on our charts, and we say, right, that's now going to be one of my key reference prices. Now, you might not have access to that information, that's okay, but that's one of our key reference prices right there. The other level I've now got on my charts, as you know, is one of the levels I've just mentioned, 41.31s, 41.32s. Well, most of you would be able to find that trade, wouldn't you? Because there's a nice big sell side order block just below that key level, 41.31, 41.32. So we already know about that price, don't we? So now we've got some ideas. Now there's a couple of other things that we can recognize in the background. If I zoom out a little bit, take a look at where today's market low is. Well, that's not that difficult, is it? There's today's market low right there. Sorry, today's market low from yesterday. Okay, so that's the US session low at 41.13s. So that's a good starting point. We've already got that reference available to us to start our day. So how many people started by marking off the things you already knew about in terms of levels? In other words, did you just pass the market maker's challenge for the very first part of this trade? In other words, did you look backwards to find key references? If not, you've just learned something new already. You're starting to find something to start drawing on your screens on the right-hand edge of your charts. As we go forward, we can see that coming into 7 o'clock, now what we're trying to do now is start to draw in some structures. We said to start at 7 o'clock, so we can already recognize that the structure is now bearish. We can recognize that we've broken some structures on the way down to the current price area here. We can start drawing in some structures. So in other words, there's a break of a structure there. The high price of that structure would have been here. We work our way from the forwards to the backwards so that we can start seeing where these structure break ideas are coming from. So we had a low price here, a high price there when it broke, and that gives us a new high structure. When the price breaks this structure, we've now got a new high structure. Now, you can get as aggressive as you like on this, by the way, guys. Now, some people will then look at this and say, right, well, I had a break of structure here. That was a good pullback for 6 ticks here. We broke structure here, so the high of the structure is now this price. There's nothing wrong with that analysis. If you didn't want to have that as your break of structure, you'd have somewhere else. Good, so what? Nobody cares. Your structure is your structure. It's just a way of being able to visualize the price action that's happening. So obviously when we start to see this, we can start to recognize a couple of other key elements. Number one, we broke structure to the upside. So this is the first break of structure we've seen reversing the market right here, correct? That's the first break of structure. So now we're thinking to ourselves, market's bullish. So what I'm looking for is I'm looking for perhaps a level 2 buy trade. We've broken structure. You might say, but is the drive to the downside not also a break of structure? Well, not really, because it doesn't really give us any solid selling below the bottom edge. Some people might argue that there's no really solid buying above the top edge, but the buying came in from the halfway stage here. It wasn't from the bottom edge. The buying didn't just go from the bottom edge to the top edge. There was buying running up into the top edge. So there's a little bit of subjectivity in that, but that's okay. We can live with that. We're not saying that all of a sudden you're buying here. It's just an observation at this stage, correct? There isn't a trade taking place. So don't start thinking to yourself, cherry picking some examples here. There's no trade. We're not saying that you're buying here and all of a sudden you didn't get stopped out here. That's not a buy trade. It's an observation. So what else was an observation? When the price comes down, we can see a couple of key aspects of trading. We introduced this actually on the very first day we started in this free series of webinars, and that is the concept of fast and slow. The concept of fast and slow is a very, very simple concept. In fact, the candlestick guys recognized the value of fast and slow when they came up with a candlestick formation specifically for fast and slow, and they called it a bullish 3 or a bearish 4. They called it a bullish 3 or a bearish 4. There may be other names for it, but basically a bullish 3 would look something like this. A bullish 3 would look like a big upside candle, a slow, gradual pullback to somewhere, and then a bullish upside candle. That's a bullish 3, and the 3 comes from the number of candles inside of the 2 toxic buy candles. What we know it is simply fast and slow, and that's a very, very simple way to understand this. This is a fast up candle, these are slow down candles, and this is a fast up candle here. So fast and slow is part of that toxic background that we've already talked about many times in the past. The idea that we've got a fast money move to the upside, a toxic move to the upside, means that the market's more likely to be bullish. So in other words, when I look at the bottom edge of this S&P at 7 o'clock, do you see any fast and slow? I know what I see, but do you see any fast and slow moves? Take a look for yourself. How fast was the last up move at 20 past 7 this morning compared to how fast the down move was following the fast up move? There's a massive difference in speed. Look at the size of these 2 candles, and then look at how long it takes to get back down to the bottom edge. Do you see it? Then do you see the very toxic candle here, the very toxic candle at 7:30, yes? Do you see the very slow return back to 41.15s? Yes. And do you see the very toxic candle reversing from that bottom edge? Yes. In other words, there's some incredibly strong hints about this being a buy trade. We've already broken structure to the upside, if you like it enough. We've already broken structure to the upside. We've already seen a slow, gradual pull back into the bottom edge, which means there's a concerted effort to buy into the bottom edges slowly but consistently all the way through this whole phase here. We've ran the stops, and as soon as we ran the stops at the bottom edge, we got an instant toxic buyer. In other words, we created what we called yesterday a level 2 buyer. A level 2 was when a price breaks a level 1 and returns back inside the level 1 instantly. Well, that's what happened here. It broke the level 1 and it returned back inside the level 1 instantly. So with the break of structure above us, with the fast money break to the upside, the slow gradual grind to the downside, and then the fast break to the upside and another slow gradual grind to the downside, if I was looking at this from a trade narrative point of view, I'd be saying to myself, you know what? Buy me as much as I can into this bottom edge as soon as we get a transition. Now, I don't know if the transition is going to take place at 15 or lower, or whether the transition is going to come off of 16s or higher. I don't know what's going to happen here. There's no way for me to make an assessment against that, except take a look at our sentiment line. Take a look at our sentiment line, guys. Do you see what's happening on sentiment? Now, we've got some nice inside information now, haven't we? We've actually got some R-squared information that tells us what's going to happen. We have a lot of value starting to develop on the buy side. In other words, the bottom edge is now manufactured for our pleasure. That means that we can comfortably and aggressively start bidding the low price based on the other toxic order flow that we've already seen coming in. Based on the liquidity that we've already seen coming in, we can now recognize why, and that's the important thing, not observe that it's happened, but we can recognize why the big break to the downside was a commercial buy trade, because obviously that could have been you right there, but obviously, unless you know how to trade R-squared, you're not going to know that that could have been a buy on the downtick. Simply, it's too dangerous. So you may have to have waited for the price to rally and then fail and et cetera, before you could get into that trade. So that one piece of information alone gets you into the bottom tick price of the day at that stage. But that's not what we're here for at this stage, is it? That's not what we're here for at this stage. It was just to show you why it's so important to realize that there's a whole jigsaw puzzle out there that people simply aren't recognizing. So we showed you that same sentiment line showing up prior to the CPI numbers. So now we've got a great opportunity to buy it. We've got a great opportunity to buy the low price. So how do you trade that as a trade? Well, you want to trade a transition. Now, transitions is something that the boys will show you tomorrow because they'll be looking at some of the order flow tools. But transitions can be volume. Transitions can be your limit order book turning from a sell limit order book to a buy, and all the offers are getting pulled away on the transition, or a big volume lean that you can get accurate to 1 or 2 ticks on in terms of a stop. Or you can simply use the Heisman trade idea that we talked about yesterday. Heisman trade idea is when the price breaks the low, you simply put a buy stop order 1 tick above the high. Sorry, 1 tick above the low, so that you're trading up into your buy stop order. So if the price keeps selling off, you don't get taken into a deal. You don't get taken into a trade. When the price rallies, of course, how you manage out depends upon how the value is developing, but you may have seen a trade up here at 17 quarters and say, you know what, I'm taking my first contract out. I'm a 2-lot trader. I'm taking my first contract out because I've just reached the halfway stage on this move, taking half out, 17 and a quarter. And what that would mean is, of course, you could now run a stop of 8 ticks, perhaps, to allow yourself the opportunity to buy your second contract back in again. As the price trades back down again, you can see just how slow the pullback is back into 15 and a 3/4, right? So when the price trades back down to 5 3/4, we're looking at that saying, you know what? We're back in transition again. We're back into this idea of as soon as that price transitions, I want to be in it. But what if you don't have transition tools? Well, you've now got a break to the upside. You know the market's bullish. You've now got a top line here. You've now got the ability to start trading it for a interns trade here if you wanted to. You're now buying the market, right? You've now got an actual opportunity, regardless of any other tools. You've got an opportunity to buy this marketplace. Now, in a world of micro trading, you might argue with us and say, well, we took out that high there, so that's a break of structure. This did not take out the low, so that's a failed auction. So when it takes out the high there, that's a break of structure in that direction. That's an interns buy trade. So it doesn't matter how we dice this. It's a buy trade. Now, obviously, the ability to narrate this information is getting more and more important. When we see this happening, we can understand that there's obviously something happening in this area. What we do is we mark this chart off here, and we call this a cap seller. Now, understanding what a cap seller is very important when you start to understand the concept of order flow manipulation, and we'll show you this when we talk about bear raids and pump and dumps. A cap seller is usually something that takes place in the world of order flow. It's a buyer at higher prices that gets jammed, and the idea is to take the price back down to the bottom edge to sweep the stops, which is obviously what we would call a bear raid. So we take the price down, sweep the stops, hopefully somebody all pukes into this trade. Hold on 1 second.
Don't worry,
Sorry about that.
haven't lost.
Okay, so this is the kind of concept of a bear raid. So we take the price down, try and get people to puke their positions, and obviously we just buy into that storyline. We buy into their stops, we buy into their selling, and we get the liquidity we're wanting. And we're going to show you a brilliant benchmark example of this, guys. We're going to give you this by the end of today's classroom, if you've managed to stick around long enough for it. Okay, so we're going to give you that tonight to look at the idea and the concept of bear raids. So when we come back up into the cap selling, we can see obviously we break through the cap selling, which is good news, because the cap selling gives us something else. It gives us the concept of a measured move. If that's a cap seller and I've now got a bottom edge price, I've also got the ability to come up with my initial targets. My initial target is simply 1 times the distance from the cap sell to the bottom edge. And I don't take the whole area, I don't take a single price, I mark off the top edge there. And I look in the background to see if there's any relevance to this area. And there is, because we can see that the selling came in from that exact area. That toxic seller that came in here that drove the market south from 6 o'clock this morning was resting at that very price. So we already know that this price area here has relevance. And this would obviously be something we would then be able to mark up as a bearish order block. Now, did you spot that? Give yourself another point. You're starting to see the kind of information that you need to know as a trader, because you know that this might be a sticking point for progression to the upside. Let's carry on with the rest of the charts here, guys. Let's keep going. Okay, so we've now progressed matters. We can see that we've broken some really nice structures. We've got a very, very good build at the top edge. We've developed this very, very simple P shape at the top edge, which is a very profile concept. We've got this very, very nice P shape forming in terms of profile. We can see that obviously what happens next is we run the stops again into the bottom edge. Now, why did they run the stops? Why did they run the stops? Now, I'll give you a clue. Let's suggest it's maybe something to do with something Gann talks a lot about. Again, let's see if you can pass the market makers challenge. Why did we run stops at that stage? Well, we know that the London equity markets open at 8 o'clock. So in other words, the run of stops was at, you can see the run of stops was just after 8 o'clock. Look, it's 8:08 in the morning. In other words, what's happened is London's came to the desk at 8 o'clock in the morning. The price has already rallied quite a distance. London's not getting the price they want. So London's basically saying to everybody, look, let's take this price down a little bit here, guys. Let's get some of these buyers off the trade. Let's take the price down if we can. Let's run the stops again, and then let's go again. You can see we're obviously getting very close to that 41.13 level that we already knew about, that we tweeted last night. So what happens? The price runs the stops to the downside. We're still inside the structure at this stage, so the structure high is now up here. We're still inside structure because the structure never changes. When the price breaks, you're thinking that's a break of structure. Well, it is if the sellers come in below this price. But did the sellers come in below this price? No. The price actually rejects off the 1375, rallies back inside value, And what we're actually left with is another level 2 trade. Did we not teach you this yesterday? Did we not teach you one of the key core ideas of commercial trading is this idea that when we're trying to accumulate a position, I'm pretty sure we did do this yesterday, when we're trying to accumulate a long position, a lot of the times what you'll see is this type of pattern here. Yep, did we show you this yesterday? And what we said was every time we break a new level 1 at the bottom edge here, and we get an instant rejection, you mark that as a level 2. And what will happen is you'll see a lot of level 2s starting to structure something like this. Now, we kind of coined the idea that this is called simply the once, twice, three times a lady, based on the song, of course. Once, twice, three times a lady. And the reason why we use that is because it sticks. People remember about it, right? It's something that people remember. It's that kind of corny kind of idea that it's got something to do with a song. But it's absolutely spot on, isn't it? This is how an accumulation takes place. So this is level 2. This is a level 2 accumulation. This is a level 2 accumulation. This is what we would call the cap sell level. And once the cap sell level breaks here, it turns into a pending buy level right here. In other words, we've already shown you this. Well, if this is what you've now seen, and this is what you now know to be potentially true, is that what this looks like down here? Does this look like something similar, where we've got, if we even go back in the background and count this one as a possible level 2 buy here, because it rejected and it rallied and it rejected and it rallied, is this not very similar to what we've just been discussing? The 1, 2, 3 into the bottom edges, the cap price coming in here and then subsequently in this area here, is that not exactly what we've just been discussing? It is, isn't it? It's exactly what we've just been discussing. Now, obviously, that's okay because it's still an interpretation. The only trade you've actually taken as an intern is this buy trade at this stage. And it did well. You made some really nice money from that intern buy. And obviously, depending upon your ideas, you maybe take another intern buy just there. And obviously, you made some money again in that narrative there. And then you took another intern buy here, which did make some money, but did still reverse out of that cap sell level, which isn't a surprise because of this background that we already know about. So obviously that's another intern buy that you could have made some cash once you understand the concept of tipping prices. You're going to get in at a better price. Anyway, so that stops because we now get a break to the downside and we don't get a break to the upside. It stops. So when we break to the downside and we get a level 2, this could be the start of a sell trend, or it could be a very strong signal for a continuation buy. But because of the time of the day and because of the value that we were seeing at this stage, we all think that this is more likely to be a bottom edge long position. We believe it's more likely to be a long position off the lows at this stage. It seems to make an awful lot more sense. So that's good news. It doesn't matter because you're not going to be taking a trade there unless you're trading like a commercial. As the price breaks back up again, because we haven't had a failed auction, there is no buy trade into this cap sell level. The trade actually is when we then drop back down again and we trade back up into this level 1 here. There's a challenge to that buy, and the challenge to that buy is, of course, that we've got this bearish order block right above it. So I don't really want to buy at that price. I want to buy just before that price, right? Just in case that seller comes into play and stops the price. I want to buy it, but I don't want to pay 22 3/4 for the buy trade. I don't want to pay that. That would be a terrible idea. But obviously the key to this is that cap sellers become something. Cap sellers becomes pending buyers, and we narrate our charts accordingly. Buyers pending gets put in there, the imbalance coming in for that buyers pending area. So let's carry on with our analysis, guys. So obviously this bottom edge has turned out to be absolutely superb. You can see the accumulations which maybe or maybe didn't get taken. It doesn't make any difference. We know that the trades that you would have taken so far are this trade here, this buy trade on the way up. You would have taken this buy trade on the way up. You would have taken this buy trade which may or may not have made you money. And you'd have taken this buy trade which certainly worked to the upside before you got perhaps scrapped. and you'd have taken this buy trade, which certainly worked to the upside before you got perhaps scratched on the trade. But now you're on the long side only. So now we're looking at the next level 2 just there, and we're looking for another opportunity to buy into this market break here. Now obviously at this stage, we've just taken out this bearish order block. And based on these two pieces of information, we have target prices. So obviously now we've got another target price in mind, because remember this was the original target price here from the bottom edge. But now we've got an even bigger bottom edge. We've now got this whole range here. And now our target price is starting to drive up into this order block area that we already know about at 4130s. This area that we knew about because of the tweets that we sent out last night. When we take out this bullish order block here, we replace that bullish order block with new imbalance seller buyer spending. Now obviously you can see that the price traded back to that imbalance, and you could have taken a fade trade in this area perhaps, but it's not part of the interns exercise at this stage. As we go higher, we can obviously start to recognize the next key level was this one here. It's got 2 to the left, 2 to the right. You can see actually a new key level came in just a couple of ticks below that, right there. And obviously whatever it is, you're going to be buying into that for the interns exercise. Now as I said, let's think about what happens next. Let's see what happens next. How good was that trade? Well, we got a very nice profit out of that trade, and then we set up a couple of small internal buy levels. Buy levels. Remember, we're not selling this because we haven't had any break of structure. The current structure is now here because that was where we broke the levels. Remember, it's the lowest low between the highest previous and the break of the highest previous, right? So the highest previous level was here. And the break of the highest previous level was here. So the lowest low between those two circles is this price here. So that's where your low of structure is. Did everybody have that low of structure in place? What I'm hoping is that you're doing this exercise as we're coming to it so that you can see that you're already ahead of the curve. You're already knowing what I'm going to say. And you're checking your understandings that what we do say and what you've got on the screens tie up. Because obviously so far every single trade seems to have made either a very, very nice profit or a very, very small loss, or perhaps even just a scratch trade, worst case. You're making a lot of money already, aren't you? Simply by following the interns trade without taking any of the fade trades. Now remember, as the intern goes, you wouldn't have had this buy arrow, you wouldn't have had this buy arrow, you wouldn't have had this buy arrow. This was only a demonstration of a break here, so that you wouldn't have had that buy arrow, and you wouldn't have any other arrows anywhere else. So this is the only trade so far that you would have had. Now take a look at them again. Could you have made money on those trades? Well, assuming you're running a tight enough ship, assuming you're getting the right price, assuming that you're not trying to hit the moonshot out of the park, every single one of those trades, bar one, could have made you some nice money and a stop at break even. And the one that didn't so far was this very last one. And surprisingly enough, that was the one that sent the price crashing back to the bottom edge. As we start finding some internal levels, of course, there's an internal level there. You may argue, because there's 2 to the right and 2 to the left, that there was an internal level there. So there's another opportunity to start getting involved in your buy trades. The first buy trade would be here, correct? Sure. The second buy trade would then be the breakout here, correct? Sure. Now that's a challenge because that one goes up by 3 ticks and then reverses, stops at break even. You maybe scratch out, you maybe lose 2 or 3 ticks. Okay, so you maybe lose 2 or 3 ticks. So what happens next? Your next buy trade would be just here. You've just made back those 2 or 3 ticks and a little bit of change, right? Now we know there's a target price here, so we know this price will probably get jammed a little bit of time here. So we've got to be careful here. What happens next? The price breaks that challenge price beautifully. Breaks this challenge price. Now as an intern, you're not really that bothered so long as you're still able to buy in the breaks higher. Your next buy trade would now be here. You become that toxic order flow. You can see 2 to the left would have given you another buy trade there. So you'd have bought that trade there. You'd have been buying into this break higher. Every time you see these ideas, there's another trade there. You'd have been buying that break higher. How are you doing so far, guys? How are you doing so far with this interns exercise? Making a fortune, right? You're making an absolute fortune. And it's only coming up for 10 o'clock in the morning. It's kind of crazy, isn't it? So what happens next? Well, something interesting happens. We don't get another Interns buy trade at the top edge. In fact, we do get another one of those situations whereby we had an Interns buy there that never triggered. Technically, we actually had an Interns buy trade in this area here that didn't trigger before we got an Interns buy trade there, which did trigger. And obviously, when that Interns buy trade triggered there, we got a failed auction because it never broke the next high and it came back down and scratched us out. Still made money, but it became a level 2 sell, didn't it? So now we're a little bit concerned. Now we're dragging our eye to the bottom of that break there, and we're starting to think to ourselves, is this a break of structure? Is this price going to go back down again? Because we've now got a break of structure price here. Now, obviously, at this stage, you've still got the ability, if you wanted to do buy trades on the way back up, but you can see the break of structure came in. It gives us a bit of a level 2, of course, but it still came in, a break of structure. And then we saw consistent selling in that break of structure. Now we're thinking to ourselves, wait a second. Now I'm thinking to myself, is this now a top edge sell? Now, obviously, I don't want to keep going all the way through this because I want to try and get to the CPI numbers as quickly as possible so we can catch up with the right-hand edge for the US session. But we're starting to see the process. Now, if you term this a break of structure, that's okay because there's the high price. And obviously, as you get some fractal lows, there was a fractal low price there, which didn't actually break until over here. So there was your break of structure there, yeah. So when you got a break of structure there, where is your new bullish break of structure? Your new bullish break of structure must be this price here, correct? Correct? How did we calculate that break of structure there? Because the previous low that we're using was there. The break of that low was here. So what's the highest price between those two circles, guys? What's the highest price between those two circles? The highest price between the two circles is this price here. And we've just had a break of structure against that price, haven't we? That's okay. Good trade, right? Good trade. We still made money on the sell. We never got a break of structure again from that sell there. We never got a break of structure there. We never got a sell there. You might have argued that there was a sell here. Still made money. You could still have got a profit out of that, plus a stop at break even if you're aggressive enough. You never got a break of structure below that price, however. The price rallies, and we get another couple of little pivots that don't break to the downside during this phase here. And obviously the break of structure is now bullish. The break of structure is bullish. Where do we mark the low price from? Well, that's dead easy. The prior high was here that we're counting as a break of structure. The break of structure price was here. So what's the lowest low between those two prices? The lowest low between those two prices is now this price here. Correct? So we're now bullish. We're now in a bullish market. We've got a couple of things that we can mark on the charts if we want to bring our charts right up to date. So one of the things we can now draw is, of course, this must have been a cap seller at first. If you're wanting to put on all the narratives, we would call this a cap seller. And because the price broke the bullish into a bullish structure, we would now mark off this area here as a possible pending buyer's area. We only know that once it's broken structure, of course. So when we go forward, we can see coming into the CPI numbers, where are the opportunities to deal? Well, we've now broke structure, so we're obviously going to be buying here. Nice trade, nice opportunity to buy at that stage, nice opportunity, nice profit. The next highest price, again, doesn't take a genius to figure out the next highest price. It's right there. Then we get a little fractal edge here. That doesn't break. And then we get a little fractal edge there. That doesn't break. Now, obviously, if you're trading level 2s, we've had a level 2 break coming back in here. So it hasn't become a level 2 just yet. And what happens next? Well, what happens next is we get a break to the upside here. So obviously, as you get a break to the upside, this is still before the CPI numbers. This is 27 minutes past 1. We're still 3 minutes before the CPI number comes out. So when this price breaks north, you would have been able to buy into that, break north from there, there, and or there. And obviously that buy trade at 40 goes all the way up to 47, you just made $350 in 60 seconds. Now obviously as a level 2, take a look at what this price area here is doing when you start to learn this stuff. This is an area that you now know about, isn't it? We've just told you about this area here. This is an area that we call pending buyers. If this is an area of pending buyers, as a commercial trader, I want to see if I've got any commercial value to buy in this area. So when I look for commercial value, I'm trying to figure out what's going on here. And I can see back into this area, you may be able to recognize it yourself, you may be able to agree with me, but coming back into that pending buyers area, there was a huge opportunity for me to start bidding along with the other buyers in here. A brilliant opportunity to bid against that. So now we're trying to tie in some of the other tools. Now, we're not teaching these other tools at this stage because that's what we teach in the main classroom, of course. This idea of R-squared where we get some inside knowledge of how to trade the markets. What we're trying to show you is that there is other things to this. There's structure that allows you to still get that same buy trade, just not at this price. And what happens next, of course? Boom. We never even get a chance, do we? It's never gone sell side. The market's never actually reversed back out to give us a sell side break of structure. In other words, we're in the right trade when the market breaks. Surprisingly enough, we're in the right trade when the market actually breaks north for this enormous profit. And it wasn't just any profit, guys. It was a bloody enormous profit. Take a look for yourself. Break of structure, buy trade, boom. Enormous profits. $3,000 per contract, guys, in 3 minutes. $3,000 per contract in 3 minutes. Now, would you have taken a trade? If you understand what you're doing, if you understand the concept of R-squared, you probably would have. If you don't, I'd probably recommend you don't take these gambles because you don't know what the value is doing. You don't know what to value your market at. That's the point of R-squared, is we're always buying and selling something because of value. What is it about value, guys? Let's just stop a second and think about this before we push on. What is so important about value? Well, I'm sure you've probably at some stage went to an auction. At some stage in your past, you've went to an auction, whether it's on eBay or whether it's a property auction or whether it's an antique auction at Sotheby's or Christie's or some of the big American auction houses, or whether it's a cattle auction. Perhaps you go to cattle auctions or car auctions in America. When you go along to these auctions, there might be something that catches your eye, right? There might be a Chevy from 1970 that catches your eye because of the 3-speed manual box or the straight six or whatever. There might be a 67 Mustang that catches your eye. But at some stage, if you're going there specifically for something, what have you done before you went? You've established some sort of value. So in other words, you know that there is a 67 Mustang convertible coming up for sale. You've had a look around, of course, to try and understand what the price is. What's the normal price for this at auction? What's the retail price for this car? What kind of amount of work would I need to spend to get it up to those standards? In other words, you've basically valued the Mustang before the auction starts. And if you're using your head rather than your heart to buy into this as an auction, and you think that the auction value of this car is $25,000, you're willing to do $25,000, but not a cent more, then obviously at some stage, you've got to make that decision. The car starts auctioning at $14,000, $15,000, $16,000, here now it's $16,000 and $17,000 traded. And then we had 18,000 buyers at 18,000 and 19,000 traded. Now here now 18,000 traded, 19,000, 20,000 buyers, 21, 22,000 buyers, 23,000. And you're starting to think, right, we're starting to get very close. Now, if it goes above 25 grand, that's it. If you're using your head, you're going to say to yourself, 25 grand, too rich. I'm out. I'm not trading. I'm not taking it. If you're using your heart, you'll say, damn it, I can't lose a car because, my God, I'll look like an absolute fool to all these other guys. And my wife's going to leave me because I look like a weakling. You've all been there, guys. Guys are worse than girls for this. For some reason, a guy needs to win a bloody auction, right? At any cost. They might buy a load of pish, but they still need to win the auction because I'm a guy. What the hell, right? And you end up overpaying along to the auction to buy the Mustang for 25 grand, and suddenly you're driving up the road with this Mustang for $44,000. You've just been skinned alive. But you still won the auction. My God, did you show those other buyers, didn't you? You really showed those other buyers. What the hell is wrong with you? You're never going to flip that in a million years. Now, you might want the car, and you might be willing to pay $44,000 for it, but you're not going to be able to flip it for a profit, guys. And then we're trading in the markets, not so we can own this bloody S&P. We're trying to buy the S&P so that we can flip it in 5 minutes' time, right? We're not wanting to marry the damn thing. God forbid. We want to get rid of it pretty rapidly. So we've got to make sure we get value. Very important part of the jigsaw puzzle that nothing else in the retail space answers. Value is not about overbought and oversold. If it was, we would always simply just use stochastics and we'd never lose a trade, would we? Buying a stochastic at 20 and be able to sell a stochastic at 80, you're never going to lose a trade. The maximum drawdown is 20 ticks. What the hell, right? That's got to be the best trade in the world, except it doesn't work. So let's see what happens next, guys. Let's see what happened next. We put in a top edge. Now, this is obviously now a very volatile market. We put in a top edge. You can see that the top edge comes out to play just there. Now, obviously, as we start to put in that new top edge, there was a prior bottom edge just there. Now, you can see what happened. At some stage, we actually broke structure here at 2:30. We actually broke structure here, didn't we? That's an observation. It doesn't mean we've got a trade, but what we've now got is we're now sell side only the market, aren't we? We're sell side only the marketplace. We start drawing in the low prints. There. We start drawing in the fractal low prints. There. So now we've got two intern sell trades that we can try and take advantage of. What happens? We get our intern sell coming in there and we get a profit out of that trade, don't we? We get a profit out of that trade. It doesn't seem like much, but it goes 93 quarters to 90. It's actually not bad. It's $150, guys. In 60 seconds, $150 in 60 seconds in that sell trade is not a shabby outcome. So then we've obviously got another failed auction behind us. We've got another low print here. We've got another possibility of selling. We've got another chance of making $100. And that's exactly what we do make, $100, before we get scratched out at break even again. Now, obviously, as a seller, we can now recognize the concept of level 2 because there's the level 2 sell coming in. Because remember, the structure's still bearish. The high of the structure's up here. So we're still selling. So there's a possible level 2 sell there for anybody that understands level 2 concepts and anybody understands value concepts. There's a level 2 concept sell just there. Where is the intern sell? Well, there's the last fractal edge there. So there's the intern sell right there. Where's the next intern sell? Right here. Where's the next intern sell? Right here. So what happens? We get the intern sell there. Does that make money? Sure. Makes some nice money. And then we get the next intern sell there. Does that make money? Sure. Makes some nice money, doesn't it? So now all of a sudden, if I take away all the trades that aren't trades, if I take away all the arrows that aren't trades, we're left with those 5 trades. Did you have those 5 trades as a seller in that situation? Did you and can you spot the selling coming in those locations? It's pretty good, isn't it? It's pretty solid as an idea. So this is quite useful. What happened next, guys? Well, when we broke that structure low there, we obviously had a structure here, so we now have a structure high at this price here, which we now know breaks here. We don't get any other sell trades, believe it or not. We didn't get any other sell trades because none of these prices, regardless of whether we counted this as a pivot, or whether we counted this as a pivot, or whether we counted this as a pivot, or whether we counted this as a pivot, none of those sell trades pivoted back through those levels to give us another short trade, and then the structure broke to the upside. That's it. End of the sales. End of the sales, isn't it? Good news. It's the end of the sales. So what? So what? Who cares, right? Now we've got a break to the upside. We now know where the break came in from. We've got a high price here. We've got a break to the upside. What caused the break to the upside here? So obviously we're now looking at that break, the lowest low price from that break area. We're starting to think to ourselves, well, realistically, this is the break of structure here for the sellers to come back in again. So what we're going to do is now we're going to try and buy this break. Doesn't happen. We're going to try and buy this break here. It does happen, and it makes some money. It's not a lot of money, guys, but we're scalpers here, remember. It's not a lot of money, but we're scalpers. We break here, and does it make any money? Probably not. We probably get stopped out or break even on that trade. It only goes 2 ticks higher. But then it drops back down again, and it comes back up. Remember, we haven't broken any structure until we break this line, or unless we break the high of this trade here. Nothing changes. We are only buyers in this phase. So when the price breaks lower here, we're looking at the break of structure here. We're only buyers. We get another buy trade, we make some money. We get another buy trade, we make some money. Look, we're always making money here. We're always making some cash or break-even scratches. When the price breaks south out of this area, there's no more buy trades. We can already recognize that there may have been a buy trade at the very top edge here, but there's the break at the moment. The price drops, the price drops, the price drops, and breaks the bottom edge structure that we'd originally highlighted as a sell. What happened next, guys? Nothing much. Nothing much. Let's just carry on, because the market goes dead actually all the way through this whole process. Does it lose money though? No. Does it make money? It makes some, not a lot, because the market's gone very quiet. But could you still scalp these ideas inside these breaks of structure? Remember, unless the price goes above this price, you're never going to be a buyer at any stage, right? So in other words, all you're going to be doing in this area after that break of structure is you're going to look for little pivot prices. And I don't want to highlight them all, but there was a pivot price there that made money. There was a pivot price in there that made money. There was a pivot price there that made money. There was then a pivot price in here that made money. There was a pivot price here that made money. There was a pivot price here that made money. There was a pivot price here that made money. And there was a pivot price here that made money. There was no sell came through here. There was no sell that came through here, so they didn't trade, right? So in other words, we had all these sell trades, all of these sell trades there. Sell trade here made money. A 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 sell trade here made money. And a sell trade here made money simply using pivot prices. Every single one of those sells got at least a couple of ticks out of the market, stops at break even, worst case scenario. Remember, the idea is that you'll never trade the interns exercise. And yet the interns exercise is still making money. These are the worst possible prices. When I see an interns exercise, I'm trying to get in the transition to come back to the interns exercise. So realistically, if I was looking into this trade here, if I was looking into any of these trades here, instead of selling the price when it broke back through this area here, I would be looking at the failed auction turning in there, and I would be looking to try and get into a transition probably about that price, right? When the price rallies out of this area, comes back down and then bounces and then starts trading back down again, I wouldn't be selling at the red line at the bottom edge here. I'd be trying to get into the transition perhaps somewhere about there. It's all worth an extra 2 or 3 ticks on every single trade I take. So when I'm trying to sell into this phase here, I'd probably be trying to sell into maybe, I'm not going to get much of a benefit, but probably a single candle there for a reversal there. And when I see this ledge here, I'm going to be transitioning as soon as I see a break back out of that little transition phase there. There's my sell. There's my sell. Now you might say, but that means you did get sells at the bottom edge, because you were coming in early. You weren't simply waiting for the breakout. There's always a payoff. So let's deal with the 2 trades at the bottom edge. So now I know that there's a bottom edge intern sell here. When the price rallied and then the price transitioned, my sell would have been somewhere in here. I still made money, guys. So it doesn't matter what your excuse is. It doesn't matter what your argument is. Still made money. When I then got an interns fail here and it started to transition here, I would hope my sell would probably be here, and if it wasn't, I would probably have had it just below that green candle there. We never get filled. So if we either got filled there, We still made 4 ticks and a stop at break even, right? So I could have got my sell in there, and if I didn't take that one, and I don't know what I would have done, I would have had to see the value. If I didn't take that trade there, I might have taken the trade here, in which case I'd never get filled. That's not a sell. It's not a sell. So obviously the price then goes, and we simply start getting up to the right-hand edge of the charts. Now, the one thing you'll start to realize is sometimes you want to get a little bit more aggressive because of R squared value. If we know that R squared value is very bullish, and we see this situation here, if I know that this is now very bullish market and I don't really want to be selling full stop, why can I not transition into a structure break bullish? Well, the truth of the matter is I can very easily structure, because obviously if I now look in a world of microcharts, I could now call that a break of structure level, because it is a break of structure, isn't it? I could call this the current low, and I could call that a break of structure because we get a failed auction here. When that market breaks structure here, I could now start thinking about the possibility of buying the interns rallies through this phase. I could start coming in a lot more aggressively if the value allowed me to come in a lot more aggressively through these phases. So I could look at, for example, my value, and I could come up with some ideas about whether I would want to buy into this. What do you think? Would you ever have taken that sell trade there? Now that you can see what we're looking at in terms of R squared, I suppose that's the big question. Would you have ever taken the sell at the bottom edge, yes or no? Not in a million years, right? Not in a million years would you have taken that sell trade. So by knowing that, you simply would have avoided selling there. And in fact, based on what you've already recognized, you will absolutely know that I am going to be a buyer of a level 2 right there. Now you can see the toxic speed of the response to that buy trade. You can see the fast candles going up and the slow candles going down. So obviously in that type of environment with a very bullish looking market, your first trade would actually be there, wouldn't it? If you didn't want to fade. You would have used that structure there. You would have came into that structure there as a buyer, and you've already got the big rally. You've already got the big rally. It's already made you your money. So we can start to see that we develop out these ideas. We take these ideas, we develop out these ideas, and it makes perfect sense. We're going to continue with this on Friday. But obviously in between now and Friday, tomorrow, what the guys are going to do, we're going to get 2 people coming in who have developed some software that basically looks at some of these transitions so that you can actually see whether you're wanting to be a buyer or whether you're wanting to be a seller. But before that happens, what I want to do is I want to take a look at this concept of pump and dumps and bear raids, because it's something that we've talked about in class today, and the guys seem to think it was worthwhile spending some time showing you guys. So let's take a little 30 seconds break, guys. Little 30 seconds break to tidy up my charts, and then we'll get into the concept of what a bear raid is and what a pump and dump is to finish off today's classroom. 30 seconds, guys. 30 seconds. Okay. Pump and dump and bear raids, guys. The concept of this is it goes back into the history of trading for decades and decades and decades. The idea of market manipulation, the idea of spoofing the market to try and achieve a false-looking market so that people see something that simply isn't real, something that's manufactured to make you want to buy a sell or sell a buy trade, for example. The pump and dump and the bear raid are elements of that, and it's very, very important from an order flow perspective that we understand what those elements are. The market operates in the world of the best bid and the best offer, okay? Now, here was a question that I asked in the classroom this week. Can the market go up if there's no sellers? Can the market go up if there's no buyers? Can the market go down if there's no sellers? Can the market go down if there's no buyers? Well, it's something that you say, well, wait a minute. Can the market go up if there's no buyers? If there's no market order buyers. So now what we do is we add a little bit to that definition, because some people say, what do you mean, buyers? Every trade has a buyer and every trade has a seller. So we have to expand our definition just a little bit. So the definition now is, can the market go up if there are no market order buyers? Well, theoretically, the answer to that question, most people say no, not a chance, because the price goes up because of market buyers. Because of market buyers, the price goes up. No, it doesn't. No, it doesn't go up because of market buyers. The market goes up because I decide to pull away my liquidity to a higher price if I'm the only liquidity provider. The market doesn't go up because of buyers at all, does it really? Now, a lot of people scratch their head when they suddenly realize that this is the case. So, for example, if there's 1 million market order buyers, but there's 2 million market or limit order sellers, does the market go any higher? No, because the buyers are all getting absorbed by the limit order sellers. Does the market go up? No. What happens if there's one single market order seller comes in, but there's no liquidity on the buy side of the book because there's 1 million buyers? There's no liquidity in the buy side of the book. Does the market downtick with one contract? Yes, the market downticks with a single contract. Even though the delta is 999,999 positive, the market downticks. Well, that's obviously called absorption. We now understand that very simply as absorption. Is this market bullish or bearish? Well, we don't know because delta doesn't tell me. Delta doesn't tell me. It's an observation that simply that price has had a massive absorption with a ridiculous amount of buyers. So what? Well, so what is the big question, actually? Now, let's think about this. So, just to prove the point, if this is the best offer, and I'm the only liquidity provider, right? That's the caveat. I'm the only liquidity provider. This is what I'm making a market on. This is my best bid, and this is my best offer. So I'm offering 0.7, and I'm bidding 6s. Okay? I'm offering 0.7, I'm bidding 6s, say for 50 contracts on each side. And a market order wants to sell. What happens? What price do they get? A market order wants to sell. Well, they're going to get 0.6, right? They're crossing the spread. It's a market order. They're going to get 0.6. So say, for example, 10 contracts sells into my 0.6. Okay, so that's the trade, right? So what's the delta on that chart? Well, if it's downticking the price, which we can see at the moment it is downticking price, then that is minus 10 deltas. It's also downticking the price, so we'll say that that's minus 10 tick delta, okay? So we've got the volume delta, and we've got the tick delta here. Everybody see that? Everybody agree with that? Minus 10 and minus 10. Volume delta is whether it's traded at the best bid or the best offer. Tick delta is whether it's downticked the price or upticked the price. Another 10 lot seller comes in at exactly the same price. It's still on a downtick, so it still counts as a tick delta on the downside, right? It still has downticked the price. It hasn't changed anything. So now we've got volume delta of minus 20. We've got tick delta of minus 20. Now, obviously, what happens is I really like this. I'm really, really bullish, but I don't know if I'm going to get any more sellers. I'm really bullish the market, which is why I'm happy to give these sellers a price of 6s. But I don't know if I'm going to get any more sellers. So what I do is I actually pull away my liquidity from 7s and I go up to 8s. And I bring up my buy liquidity, right? I bring up my bids, the 7s. I bring up my bid, the 7s. You may say, why did you do that? Because I couldn't find any more sellers at 6s, right? So I bring my bid up to 7s to try and encourage sellers to come in at 7s. So a seller comes in and says, oh, I like 7s. I got 6s a few minutes ago, so I really like 7s. And they sell 10 contracts to me. You see what I'm trying to show you here, guys? The volume delta is now minus 30. But because this traded higher on an uptick, the uptick delta is now minus 10. The uptick delta, because it upticked, right? The volume upticked the delta, right? So the tick delta and the volume delta actually ended up going in opposite directions. And the price obviously went up, suggesting that there is an enormous amount of absorption at 0.6 and 0.7. There's absorption. How many buyers have come into this market, guys? How many buyers? How many market order buyers have come into this market? None. Has the market went down? No. The market's actually gone higher without a single buyer being visible. The market has gone higher without a single market order buyer being visible. That aggressiveness that everybody thinks is the most important thing they've ever seen is missing from this equation, this theoretical construction. Well, this brings us to the concept of the pump and dump and the bear raid. Now, when we know what we want to know, the idea of being able to recognize absorptions, now we now recognize that this is an absorption, right? If this is an absorption, how does it look if we were to chart the volume delta and the tick delta? How would this look, guys? Well, we would obviously understand that volume delta would be going in this direction, and the tick delta would be going in this direction, and then on the final trade, the tick delta would have went in that direction, right? And we all know that the price did what? The price actually went in that direction, correct? So now we've got some ideas about some of this stuff. So there's the price, there's the tick delta, and there's the volume delta here. Okay, so now we've got some information about what an absorption looks like. Great news. The other concept to this is what we call fresh air trading. Now, what does an absorption mean? Does it mean I'm mega bullish? In other words, if I'm buying all of this selling, does that mean I'm mega bullish? Or am I closing out, for example, a short position? So I'm not bullish at all, I'm just closing out a short position. Well, the simple answer is absorption doesn't tell us that. What it tells us is something is happening that's not natural. In other words, what we're getting into is an anomaly. Now, when we think about what an anomaly is versus anything else, we can simply try and chart this. So in other words, if we've got a sell candle here, followed by a sell candle here, followed by a sell candle here, then obviously what we would imagine normal would look like is the delta would be doing the same thing, right? The delta would be doing exactly the same storyline. So the volume delta and the tick delta would all be doing the same. There's the volume delta coming in there, and there's the tick delta coming in here. So the volume delta and the tick delta are doing exactly the same thing. What edge have I got here? None. There's no edge here. So this is just basically what we call fair value. This is just fair value. There's no edge. So obviously that's not going to give us much that we can lean against. Now, what happens if the next candle gets a big absorption? What happens if a massive seller comes in on the very next candle here and we get this big absorption print here? So we know that there's a massive seller comes in and gets absorbed. So the big delta now does what? The volume delta surges to the downside. What does the tick delta do? Well, we don't know exactly what the tick delta does, but let's imagine for a second the tick delta just goes sideways. Is this normal? Is this normal behavior for order flow? Absolutely not, right? This isn't normal. In other words, we're starting to see that there's an edge starting to be created here. We're starting to recognize that there is a very, very interesting storyline. My job now is, now that I've observed it, is to try and figure out what the hell it is. Trading is constantly like this. We see snippets of information in real time. The success or failure for us as traders is to make a decision about what that means. It's not always the same thing. That's what success and failure as traders becomes, guys, is being able to figure out what the hell is going on and then action it before anybody else gets to action on it, right? Would everybody agree that that's a fair definition of what makes a successful trader? Perhaps not, perhaps it doesn't make any difference. It's an opinion. But in 40 years of trading, that's my opinion, and it's definitely the right opinion. Being able to interpret something as being value is a massive opportunity for me to make some money. I'll give you a great example from a classroom we did this morning with some of our Dutch friends in the room. And this was in the London session. The question was, how do I trade gold? That was a question. Well, let's make it up. That wasn't quite the question, but let's make it that this was what the question was. So we got into a gold discussion about R squared, for example. And this actually is what was happening at the time of the discussion or subsequently to the discussion. On the left-hand side, we've got the gold chart against R squared. And on the right-hand side, we've got order flow. Same chart, same time of the day. You'll see the same time of the day, 1310 at the bottom edge of the left chart, 1310 on the Sierra charts on the right-hand side. On the left-hand side, this is R squared. This has got R squared narratives on it here. The trade that we're taking is the orange line. Surprisingly enough, for gold, it's the orange line. This is a positive correlation, right? So one of the things that we can recognize on R squared on this occasion is that gold seems to be overpriced. Would you all agree with that? It's not massively overpriced, but it was the example we were using at the time on the right-hand edge of the charts to explain the concept, right? So it's not massively overpriced, but it definitely flips from being underpriced to overpriced from here through to the top edges up here. So now we expect the blue line's dropping, the black line's been dropping in the background for some time, and the gold line is actually making higher highs. So I think there's sell value. Now this is important because now when I know that there's short value in this trade, right? So I want to start offering gold at the top edge. If I want to start offering gold at the top edge, one of the strategies for offering gold at the top edge is a strategy called a pump and dump. In other words, what I'm going to try and do is I'm going to try and pump the price of gold higher to get liquidity to sell into the gold market at the top edge. Gold market's a very skinny liquidity market. We need to take top edges and bottom edges out to get any type of sell side or buy side opportunity to add some volume to our already established value. Value without volume is useless to me. Volume without value is useless to me. I've got to have both of these things. So I definitely have value, but can I get volume? Well, if I'm a volume seller, what must I find, guys? If I'm a volume seller, I must find a volume buyer. Does everybody agree with that? If I'm trying to sell a lot of volume on gold, I've got to find some idiot to buy into that top edge. I've got to find a buyer somewhere. Hence the reason why the pump and dump is a very relevant narrative, right? We're going to try and pump the price higher to try and bring in loads of buyers so that we can sell to them at a ridiculous price, massively inflated price. But we don't just get 5 contracts, we get 500 contracts on the short trade. Take a look at what happened in gold. Let's just go through the narration here. The candlesticks that you see on the screen is the gold price. The blue dotted line is simply the volume delta, and the orange dotted line is the tick delta. So let's think about what happens. Let's analyze at 12.54. The reason why 12.54 is because at this stage gold was making a low price and we want to try and get it into this value high. So a lot of sellers came in. Why did a lot of sellers come in gold at 12.54? Because at 12.54 gold actually looked as if it was maybe a little bit overpriced, and some sellers came in to try and drive the price lower. So obviously those sellers came in. Now we're not doing this trade at this stage because we don't know the trade exists, because it wasn't until 1:05 that we're now looking for this pump and dump, but somebody's already doing this. How do we know that? Well, let's think about what happened to the sellers. We can all see the delta sellers quite vividly on the charts, because there's the delta sellers right there, right? The delta selling came in massively during that period at 12.50. Massive amounts of sellers came in, and yet the price on gold never even dropped. So gold was absorbed at this price here, wasn't it? Gold was absorbed there, gold was absorbed here. So that's absorption. Now, what is that absorption? Well, at this stage, I don't know what the absorption is. It could be anything, but what I have recognized is that there's something happening. There's something going on. And because I now recognize that there's something going on, I now focus my attention on R squared. Somebody somewhere is doing something. That's all I can say at this stage. Somebody somewhere is doing something. And then as the price goes through to 1:05, the gold price rallies. 1:05, the gold price rallies into a new high. When the gold price rallied at 1:05 into a new high, the value of gold dropped, didn't rally. See the blue line dropping? The value of gold actually dropped at 1:05. In other words, that absorption was trying to get these sellers to throw away their positions. That absorption was taking the price up so that all these sellers that came in early get stopped out and they all puke their position. They all become buyers at higher prices, allowing the knowledgeable insider who organized this program to sell to their buying at a higher price. Did it work? On this occasion, guys, it worked unbelievably well. It was absolutely perfect. Look at what happened next. So we can see that this is what we call a pump and dump. The orange line's trading above the blue line, significantly so. The sellers have came in here. They've got jammed. The price is going higher. The price is going higher. The sellers are starting to panic. And then the sellers all panicked, didn't they? Look, they all puked. Every single one of those sellers that came in on that drop there puked their positions. They just got rid of all their shorts, which meant they started to buy massive amounts of gold at higher prices when we knew the value of gold was dropping, guys. We knew in this area here that the value of gold was dropping. And yet we were able to encourage buyers to pay a massively big price, massively inflated price, because they're puking their sell positions at higher prices because they're getting stopped out. You might not like it. You might think it's a little bit underhanded, guys, but come on, it's the marketplace. If you don't grow some, you're never going to win, right? It's as simple as that. If I'm going to win, somebody's going to lose in most cases. It's not a zero-sum game. There's hedgers involved and there's various other things. It's not a zero-sum game, but let's assume it is. You've got to say it's not a bad thing, guys. It's just the game that we're in. It's like playing American football, right? You're going to have to knock somebody out. You're going to have to gouge their eyes. You're going to have to get under their shoulder pads. You're going to have to give them a slap along the ear. You're going to have to try and mow them down. And the more times you mow them down, the better the trade outcome is going to be. It's not a nice game we're in, guys. We're not here to make friends. We're here to beat the enemy. We're here to beat the opponent sitting opposite us. And at this stage, the seller's already in. These guys here are going to be my meal ticket to get short gold. Now, I didn't know that at the time because I couldn't see the value. I couldn't see what the story was. But what I could see was something was happening. Do you see what I'm trying to say? I could see that during this period, something was happening. Somebody was absorbing lots of selling And the only reason somebody might absorb lots of selling at higher prices is because they want the price to go higher. But why do they want the price to go higher? Maybe they're massively bullish and they want to take all that trade on. That might be the excuse, right? But when we looked at value, how could they possibly be massively bullish gold when gold is overpriced against value? So the solution is, to the question, the answer to the question is, they're not massively bullish. So why did they absorb the selling? Because what they're going to try and do is pump and dump them. They're trying to go and take the price higher, pump the price higher, so that these guys who have sold positions dump their positions right into my sell order at higher prices. And I can now join in with that trade because I've now identified, and I can now join in with that trade because I've now identified the trade rapidly on the right-hand edge of the charts. I can now take part in that bit of business. Whoever's doing it, I can now front run them if I wanted to. I've now got the ability, I've now seen behind the curtain. I've got the ability to now take the trade. As soon as these guys start puking, and you see that big rally in the delta there, massive rally in the delta, and the price does not go any higher. So in other words, the seller's now selling. The seller who organized that whole trade is now selling. The buyers don't realize, because they were originally sellers, they had the right trade, they just had the wrong price. All those sellers were correct, and yet they all get stopped out because the guy was able to take the price higher. They were able to stop out all of those sellers, get all of their liquidity, and then rattle the price. Imagine you're sitting as a retail trader. How many times have you said that? Damn it! I was in a sell trade. You won't believe this, guys, when you hear this. I was in a sell trade in gold. I saw a great opportunity. I got some good size. I got 10 contracts short gold. I paid 8 evens. And then they ran my stops to the tick. Literally, I had a stop at 9, 9.5. They ran my stops to the tick. And what happened next? The price sold off exactly as I thought they were going to do. The price sold off right past my original entry price, and I would have made a fortune. Instead, I lost 15 ticks. I can't believe it. They literally screwed me to the tick. They took my stops out to the tick. How many people have had that conversation? Probably every single one of you at some stage. Because that's how the game's designed. They're going to screw you unless you know what the game is. They're going to rip the proverbial piss right out of you because you don't know what the game is that you're playing. This was organized to accomplish that exact outcome. Do you get it? Now, obviously, this idea of seeing this in its own right is simply telling us that there is something happening. We've still got to take that next step of understanding what it is that's happening in those areas. But it's a warning sign. You might be saying, but if I don't know what R squared is, how do I know what's happening in terms of that gold price? Because all you're knowing at this stage is a warning sign. All you're going to start thinking is something is happening and I need to pay attention to what that something is. We've seen several great examples of that happening today. There was a great example here on Treasuries. This is the 30-year Treasury bond contract. Take a look for yourself at a perfect example of a pump and dump. Another pump and dump, right? Now, we obviously knew that the bond was a sell because we've obviously covered that in the earlier classroom at the beginning of today's classroom. We talked about this idea of what a pump and dump looks like. But take a look at the delta. In the early stages of the price rallying, the delta was bullish, the tick was bullish, and fair value was dominating the move higher. Fair value was dominating the move higher. So fair value is dominating the move higher. Have we got a chance to trade? No. There is no trade. There is no edge. We just let it go, right? We let it go. So what happened next? Well, we saw some heavy selling coming in just here. We saw some heavy selling coming in there. Do you see it? So we're starting to see that heavy selling coming in. Now that heavy selling, the price does downtick, but look at the orange line. The orange line actually upticks. So in other words, we have something happening, don't we? Something is happening here. This feels like a pump and dump scenario. If the orange line's above the blue line, it's a pump and dump. If the orange line's below the blue line, then of course it's a bear raid. So we start thinking about what could be happening here. So this looks like a pump and dump. In other words, they're absorbing that selling coming in here. So I simply mark off my chart with a couple of arrows here, right? I simply can mark off my screens with a few arrows. It looks like they're absorbing on the downtick. If they're absorbing on the downtick, what are they trying to accomplish? They're trying to accomplish a puke. They're trying to get those sellers to throw away their positions at higher prices. And guess what happened? On the next series of buy trades, there was a very, very, very substantial rally in the market deltas, wasn't there? A massive rally in market delta. Way beyond what we saw in the previous rally. Way beyond that level. And yet, look at the price. The price was nowhere near the same level as the delta, which means somebody started to absorb all of those upticks. Somebody was absorbing the puke. Somebody was absorbing all of that buying on this candle here, and the previous candle, and the candle before that. Somebody's absorbing all of that business. Now, if you remember our original conversation about bonds, what we suggested was that we were bearish bonds following the CPI numbers because that's what the curve told us to be on. We knew from the curve that we wanted to be short bonds. So when I see this absorption taking place, is this not a story that I want to take advantage of? Well, the answer to that question is yes. So where do you start selling bonds? You start selling bonds at the top edge up here, around about 143.14s up to 143.16s? Well, possibly. But what we can do is we can start looking for a transition trade. We can start looking for sells coming in the limit order book. We can look for the lean that's taking place on those upticks. There's going to be one, right? Because you don't get that much buying delta without getting some buyers getting stuck and getting some simple to see absorptions on the order flow and the footprint charts. And all we do is we put a sell stop order one tick below that buying order that's trapped. And then we simply sell into it, and all of a sudden the bond price just collapses behind that very simple trap trade. It's an incredible, incredible bit of business. That simple pump and dump narrative. When we see this, we can start to recognize that context is incredibly important in our trading. You can start to recognize when the idea of pump and dump and the idea of bear raids becomes something that we acknowledge happens. And not just the fact that we acknowledge that they happen, we can actually see them happening, and we can say to ourselves, okay, it doesn't give me a buy and it doesn't give me a sell. It just gives me a heads up that something is going on. What happens in the retail space then is you then go away to your charts and you try and figure out as quickly as possible what it is that is going on. What are they trying to do here is what your question is. I can see it's happening, but why is it happening? Why are they absorbing the selling here? Well, if it's bearish, the only reason they'd be absorbing selling is because they want to try and get those sellers to puke. It's the only reason. If the market's bearish, why would you want to absorb any selling? You'd be a seller, so you've got to try and get those sellers to puke their positions at higher prices so that you can become net short the position. It's the only explainable excuse for that type of behavior. And obviously when you think about that, you then go to your charts and say, have I got any R squared to sell bonds? Have I got any reason at all in the marketplace to get a short bond position coming off that edge? And that's what we start to ask the question about. We start asking the question, have I got anything to work with here, guys? Anything at all? Give me something that tells me why you're doing what you're doing. And I'll be able to take advantage of that something in that area. Obviously, there's a lot of things that we could look at in terms of trying to figure that answer out. We could look at all sorts of pieces of information from outside markets to inside markets. We could look at various curve narratives. We could look at various macro narratives. We could look at some outside markets and inside markets. And that's not our intention to do any of that, obviously, today. All we've got to try and understand is, was there any reason for the sellers to come in? And I wanted to show you the main reason why the sellers came in. Now we know that today is all about the direct dealers. It's all about the CPI numbers. And what actually happened on that sale for that to happen here was because we just came into the US cash market open. We just came into the US cash market open. And what happened, of course, was that the direct dealer started to sell treasuries in here. We started to see the direct dealers starting to get short treasuries. We came into a key price level, and now we're starting to recognize the possibility that there is a possible sell trade developing in here. Now, they changed their mind here, but they went back into the short trade short term, and it gave a little bit of a glimpse of the possibility of getting that bit of business just in there. There was a second reason, and that is that we started to see some heavy trade coming in on this part here. Prior to that, this market actually looked relatively bullish. Prior to this, the market looked actually quite bullish, so we were glad to see it turning off. And then, of course, we started to absorb all the buyers. The buyers hadn't recognized the guys that puked their positions, that then looked at the value and says, oh, damn it, the bond price is going up. I better be long the market. I'm currently short. So they all started to buy the market, and we absorbed their buying into that sell trade. If they don't know the reason for that, you're going to be the same trader right there. You're going to be the buyer at that price against my selling. And obviously what happened next was very, very straightforward. The price dropped. The price dropped, and we got a very, very easy ride out of town. We got a very easy ride out of town on the short treasury that just kept dropping and dropping and dropping and dropping and dropping until we'd made over $2,000 per contract from that single read. $2,000 per contract. Now I did, for completeness, I did actually bid one of these drops at one stage. We knew that there was a buyable opportunity coming into one of these areas. It was 157. I did actually close out my short trade at that stage, and I took a pop at some buying in here. I wasn't right. I made money on it, but I wasn't right. I hadn't called the bottom edge properly, and I ended up having to basically just close out my trade at break even eventually at that situation there. And I missed the rest of the drop. So let's be honest, that's what happened to me. The sell was correct, but the buy did okay, but it wasn't the right trade. I was in too soon. It is what it is. The reality of trading. Sometimes you get the right call, sometimes you get the wrong call. On this occasion, my sell was perfect. My buy was leaving a little bit to be desired. Fair enough, right? Fair enough. Still made money. Still made money on the sell and the buy trade. I just never maximized my outcomes. And I know we'll get a balking for that from everybody in the room tomorrow. How could you possibly be so bloody stupid? But anyway, it is what it is, guys. So obviously we can understand that this is what happens in the marketplace. Now, what have we talked about tonight? We've talked about market structure. We've talked about level 1s and level 2s in terms of how to recognize and how to narrate a piece of chart. We're obviously limited in time to be able to do an awful lot more than this. But hopefully we're starting to give you a flavor of the reality of trading the markets, the real markets, the markets that the banks trade every day, the conversation that's happening on a bank trading desk. Not a Forex factory forum, a real conversation where dealers are talking to dealers, where big contracts are coming in from commercials who want to buy or sell the euro dollar or the Aussie dollar because they've got a big order to fill, $500 million worth of Aussie dollars. The real conversation about farmers buying and selling in the futures markets to hedge out some of the production, the oil refiners coming in. You saw from the tweets we talked about the direct dealers conversation with the Federal Reserve. The direct dealers conversation with the Federal Reserve, which led us to buy bonds before the CPI numbers. The same conversation that made us a profit of over $2,000 in 2 minutes because we knew what the conversation was. At least we had a very, very good idea about what the conversation was. It's not about the stochastic was overbought or oversold. It wasn't about Elliott wave. It was about a conversation taking place between the direct dealers and the New York desk of the Federal Reserve. We knew what that conversation was. If you want to know what the conversation is, then of course that's what the whole class is about. But in the meantime, we could also see that that conversation was creating structure that allowed us to make a read in terms of that equity buy trade and then still be in the same trade, not at as good a price. But that's more of a risk because you don't know what the conversation was. You saw the outcome from the conversation, but you weren't in on the conversation. We put you in the conversation. We put you into that conversation. You're having the same conversation as they are having. You're seeing the same things that they are seeing. This is the reality of trading, of course. This is the reality of trading the marketplace. And when we understand that that is what happens, that is the reality of trading the marketplace, you will be flabbergasted about how some of these massive calls actually end up eventually developing. Some of these massive trades that you would never have known otherwise end up developing into certain areas at certain prices. And if you can't see these things, you'd be looking at it going, I don't get it. I don't see it. I don't know what you guys are looking at. I don't see it. I don't know what you guys are even talking about in these areas. Because that's not the conversation that happens in the retail space. But it's the conversation that happens on our floor every single day of the week in this room. So when we see it, you'll be able to see it. When we're talking about it, you'll be talking about it. In other words, you'll be on top of the trades. We're going to finish off with that, guys. I know we've done another 2 hours instead of another hour. We should be doing an hour in these classrooms. I'd promised Kim that we'd try and get finished pretty accurately on an hour so that people had a better way of scheduling their day around it. But c'est la vie, it is what it is. If you left, you left. No luck. You haven't found out about the concept of pump and dumps. So put your volume profile, or sorry, your volume delta on the charts, put your tick delta on the charts, look at the difference, spot the manipulation, and just recognize there's a manipulation taking place. Try and think about what the manipulation is. Think about where that manipulation is taking place and think about what it means to see it. This is the concept of absorptions and asymmetrical order flow. This is the concept of anomalies in order flow versus the reality of the market pricing. And when we see anomalies, we see opportunities. An anomaly is an opportunity. We don't know what it is. Sometimes it goes with the delta. Sometimes it goes against the delta. But what we do recognize is it is an anomaly. And therefore, something is going to happen. When what we do in our room is we try and interpret what it is that's going to happen before it happens. What you do, if you don't know that, is you simply wait for whatever it is that's going to happen, and you jump on board. You're going to miss the best prices, but you're still going to be involved, guys. Have a good one. I'll see you guys on Friday. I won't be in tomorrow night, but the guys will be in showing you some of the tools that we use in terms of order flow to find some of these trade ideas. And you know, they're all order flow tools. They're nothing to do with R squared, so don't be disappointed. They're order flow tools to help us identify some of the turns in the market, some of the transitions, and the guys will introduce you to those tool sets tomorrow. And then we'll be back in here, normal time tonight on the Friday night. We'll be back in here to go through basically a wrap-up of what we've done to date. And then on the Saturday, if you decide to join us on the Saturday, it's basically more of a full benchmarking workshop where we'll go through the whole process on one series of chart action. We'll really drill down into the candles. We'll look at the delta that was forming on those candles, and we'll try and establish exactly where the buy and the sell is using some of the order flow tools that you've been introduced to on the Thursday. So have a good one. I'll see you guys that are regular traders in our room tomorrow morning at probably 10 o'clock, 11 o'clock in the morning. And I'll see you guys on Friday, everybody else on Friday. Have a good one. Hope you've enjoyed it. Hope you've learned something. And I'm going to say in the meantime, adios amigos, arrivederci, auf Wiedersehen, sayonara, tot sehens, tax, gado, dos vidania. And spasibo, guys, in the meantime, ciao for now.